Market structure refers to the way the price moves in the market. It's the backbone of any trading strategy because understanding the market structure helps traders identify trends, reversals, and entry points. Without understanding market structure, trading becomes like sailing without a compass. You're simply guessing the direction. Market structure is built on trends, bullish, bearish, or sideways, and knowing these will give you a clear map to navigate the markets. In this video, we will explore how to identify market structure, recognize key patterns like higher highs and lower lows, and learn how to use structure to make better trading decisions. In market structure, we mainly focus on three types of trends. Bullish trend. The market is making higher highs, HH, and higher lows, HL. If you're in an uptrend, this is your signal to look for buying opportunities. Bearish trend. Here, the market creates lower highs, LH, and lower lows, LL. This is the perfect environment for looking for selling opportunities. Sideways trend, range-bound market. When the market moves within a horizontal range with no clear higher highs or lower lows, we call this consolidation or a sideways market. It's a choppy market, and you must be cautious during this phase. Let's dive deeper into the key concepts of higher highs, HH, and higher lows, HL, for a bullish trend, and lower highs, LH, and lower lows, LL, for a bearish trend. Higher highs, HH, occur when the price moves above the previous high point. Higher lows, HL, are formed when the price makes a retracement and then creates a higher low than the previous low. These two together form a bullish structure, indicating that buyers are in control. On the flip side, for a bearish market, lower highs, LH, are when the price forms a high below the previous high. Lower lows, LL, happen when the price drops lower than the previous low. When the market creates these lower highs and lower lows, it's a clear indication that sellers have taken control. A break of structure, BOS, is an important concept in market structure. This occurs when the market breaks a significant high or low, indicating a potential trend reversal or continuation. In a bullish market, a base of structure happens when the price breaks a lower high and creates a higher high. This confirms that the trend is continuing in an upward direction. In a bearish market, a base of structure occurs when the price breaks a higher low and creates a lower low, signaling that the downtrend may continue. A change of character refers to a shift in the market's behavior. It happens when the price action no longer follows the pattern of higher highs and higher lows for bullish trends, or lower highs and lower lows for bearish trends. For example, if the market breaks a key high but fails to continue forming higher highs, that could be a change of character, indicating that the trend might be losing strength and could reverse. Recognizing change of character early allows you to adjust your strategy, either by exiting a trade or preparing for a potential reversal. Now that you understand the basics, let's move on to identifying trends on the chart. Start by identifying key highs and lows. Look for higher highs and higher lows to confirm an uptrend. Similarly, if you see lower highs and lower lows, the market is in a downtrend. By drawing trend lines or marking major swing points, you'll be able to visually track the trend and identify where the market is headed. The market moves through different phases: expansion and consolidation. Expansion occurs when the price breaks out of a range or consolidating area, creating a strong trend, either up or down. Consolidation is when the price moves sideways within a range or forms a pattern like a triangle, flag, or rectangle. This is where price takes a breather before deciding whether to continue in the same direction or reverse. Recognizing these phases helps you avoid entering trades during periods of low volatility and wait for a clear trend to develop. Trading with market structure involves looking for clear entry points that align with the trend. In an uptrend, look for pullbacks to the higher lows before entering a buy position. In a downtrend, enter when the price forms lower highs and starts moving lower again. Using structure to time your entries helps you align with the market's natural flow, increasing your chances of success. When trading with market structure, beginners often make some common mistakes. Ignoring the trend. Always trade with the prevailing trend, not against it. Chasing breakouts. False breakouts can lead to losses. Wait for confirmation before entering. Overcomplicating things. Keep it simple. Focus on clear patterns and price action. Avoiding these mistakes will help you trade more confidently and effectively. In conclusion, understanding market structure is a vital skill for any trader. Remember to look for higher highs and higher lows in an uptrend and lower highs and lower lows in a downtrend. Recognize key points like base of structure and change of structure to stay ahead of the market. Keep your trades simple and aligned with the market's natural flow. Mindset. Tip: stay patient and disciplined. Trust the structure and allow the market to reveal its true intentions.